Hello everybody, welcome to this edition of the Investors Wisdom Nuggets. In this episode, since I have made an undertaking to respond to questions, I will be responding to a question which was posed by one subscriber. This subscriber said, I am 32 years old, I am working, I already own a property, and the income that I get from my job is adequate to take care of my current needs. I have an investment horizon of between 15 to 20 years because I'm actually investing for the benefit of my family in the event that nature takes its course on me. So my response to this subscriber is, from what you have explained to me, your situation, you are an investor who is looking for one, security of the investment. Number two, you are also looking for growth. Investing in a second property, in my view, is not the best alternative for you because you will be duplicating the risks that you are already exposed to. Secondly, a real estate investment does not offer you the high rates of growth that you would anticipate for an investment horizon of 15 to 20 years. Number three, an investment in a house is not very liquid, it's not very marketable. It's so difficult to sell houses at fair values. For example, you would realize if you randomly check on the market, some properties have been on the market for 2 years, no buyers, no offers. And the other thing is, you cannot divide your house to sell it in parts. Houses are not divisible investments. It's either you are selling everything or you're not selling anything. So I would consider investing in other alternative investments. My first asset class that I would consider for this particular subscriber is investment in equities, buying listed shares, listed stocks. And when you are buying listed stocks, because your target is growth, I would advise this subscriber to avoid mature stocks, mature entities. For example, you look at organizations like Barclays, organizations like Old Mutual, organizations, even to some extent Econet. Do they still have realistic chances of doubling their share prices in the next 2 years, in the next 12 months? I would not say so. So I would advise this subscriber to consider stocks with high growth potential, stocks which are on the introductory phase of their life cycles, stocks in technology. Those stocks currently, they have high growth potential. I would consider buying penny stocks. What are penny stocks? These are stocks with a very small market capitalization. These stocks usually are tightly held and they don't have many shares trading on a day-to-day basis. This sustains their prices, number one. Secondly, these stocks, because institutional investors are usually not very keen on them to do research and evaluate their performance, they usually benefit from market mispricings. You may find penny stocks trading at 50% discount, and because those giants in terms of portfolio managers, fund managers who buy stocks in volumes and for high values, they are not really keen on them. Their prices will be discounted, and it's very easy for them to double their prices overnight. So I would also consider that category of stocks. So over and above looking at the market capitalization, just look at the business model, look at the future, where we are going. Technology stocks have very high potential as we stand. I'm not talking about bonds because bonds, they are very low risk. So because this investor is interested in growth, I think this growth and security of the investment, those two attributes are only found in equities. Kindly subscribe to my channel if you haven't subscribed. If you believe what I'm sharing is valuable content, kindly share this with colleagues. Thank you so much for your time. If you have any other questions or burning areas you want me to address, inbox me without fail. Thank you so much for your time. Bye till we meet again.